Welcome to the third video of the first module in cryptocurrency trading, how to profit daily with technical analysis. This video is about Fibonacci and Fibonacci extensions. Now, Fibonacci is a sequence of numbers that traders will use to predict support and resistance. Now, having said that, it's found throughout nature. It's named after a mathematician named Fibonacci who did most of his work in the early 1200s, and he noticed ratios of repeating patterns in crops and streams, features on the face, and people's reaction to them, those types of things. It's just a repeating pattern through nature. And it's thought that perhaps maybe psychology is influenced by this as well. Suffice to say, Fibonacci has its detractors and skeptics, and my best opinion on this is just simply there's a certain amount of self-fulfilling prophecy to Fibonacci. So whether there's actually something to it or not, it's irrelevant. What is relevant is the market tends to react to it. So very interesting to say the least, and something that a lot of traders use, and therefore people will use Fibonacci, and if enough of them use it, it creates the effect. So at the end of the day, it really doesn't matter. It just matters that it's overall more effective. So TradingView gives you the opportunity to put down these Fibonacci indicators. And the first one I'm going to talk about is a Fibonacci retracement. And the theory is that at certain percentages of an impulsive wave, and in this case we're looking at a downtrend, but it works the same as an uptrend. Once you get a retracement, there are specific levels, percentages of the impulsive wave that you may find a resumption of the overall trend, new sellers coming in. So what if you had a predictive way to find that? That's the idea here. And Fibonacci is widely enough followed that, again, it doesn't matter if you believe the mathematics or if there's anything to it, that there is the self-fulfilling prophecy aspect of it. And at the end of the day, we're here to profit. So the idea is that at these specific levels, you will see a reaction. If you go to the second menu, click on the arrow. This is the pitchfork menu, but it also has many other things, as you can see. You click on Fib retracement, that's short for Fibonacci retracement, and then you have the indicator active. Now, what you need to do is you need to find a swing high, which this was. A swing high is simply the highest point before the market rolls over, or a swing low, which is the lowest point before a market rallies, and then you draw this indicator. So you click on the chart, and you drag, in this case, in a downtrend from the swing high to the swing low, which is down here at this case. And you can see that by default, it forms this rainbow pattern. Now, you can change this, of course, with your usual formatting tools, but this is the default. So what is this telling us? This is telling us that this impulsive move lower, a retrace of 100% of the move, goes back to $304 in Ethereum. The Fibonacci ratios are laid out ahead of time when you put this indicator down, and they will show percentages. There's 23.6, 38.2%, 50%, 61.8%, 78.6%, and of course 100%. So there are a few fib levels that are going to be more interesting than others to most traders. That would be 38.2, 50, which is huge, and ironically not a Fibonacci number according to the mathematical equation, but it's something that's been used long enough that people just take it at face value. And then 61.8, which is known as the golden ratio. Well, you'll notice that the market fell, and then as it started to rally, you can draw your fib, and you can see that just at the 50% Fibonacci retracement level, it started selling off again. And you can use these as guidelines. Now, should you trade solely on Fibonacci? Probably not. But with a little bit of candlestick observations, you can see that there were several shooting stars, which are negative candles, just could not rally. And that showed signs of trouble. Beyond that, there was an impulsive move lower right at that level. So that's another reason to think that perhaps there would be sellers there. And then you have the 50% Fibonacci retracement. So you can see how important that would be as a level. So let's go ahead and remove the Fibonacci tool and let's zoom out to an hourly chart. It's important to take a minute to look at swing highs and swing lows. So as I zoom out, I'll go ahead and mark a few, give you an idea of what you're looking for. We fell here and we bounced. That's a swing low. We rose here and then we fell back. That's a swing high. Swing low, swing high, swing low, swing high, swing low, and then a breakdown. We didn't even really get a swing high from there. I suppose you could call it that, but that's not enough to be worried about. And you can see that that's just how the market undulates. So that's something that you need to be familiar with. So let's go ahead and look at another Fibonacci tool called the Fibonacci extension. It's based on the same mathematical ratios that Fibonacci came up with. Only this time, what you're looking for is a potential price target, not a re-entry point into the trend. So if you have broken down here, you have already been short, for example, you can go to the same menu and then sub-menu. You look for fib extension, trend-based fib extension. You draw a line from there to your swing low, like you did with your Fibonacci retracement. And then you pull it back to your level. And then you'll notice something here. This actually draws both the Fibonacci retracement tool that we had just done and then these other levels below. And this is based upon the same mathematic equations. So if you're in this downtrend and you're already short, or if you short from here, you can see that there was a lot of resistance here. There was a double top. Price couldn't get through there. As we fall, then you start to think, okay, this is the entire impulsive move, 100% of the impulsive move. Use the same mathematical equations. The next extension level is down here, which we did hit, and then the one after that is down here. So this is a way to project where you may go into the future. Now, I will caution you, extension is used less than retracement. Certainly retracements seem to be more widely accepted and used by analysts. But this is a tool that's available, and some people will actually use both. So definitely something to consider. Again, though, I would urge you to not only base your trades on Fibonacci, but also candlestick analysis, breaking of support and resistance, which Fibonacci is supposed to predict. But make sure that there's structural support and resistance there as well. Make sure you understand support highs and swing lows and swing highs, support highs, support lows, all of those before you go drawing these. Keep in mind that, like with all things technical analysis related, Fibonacci works better on higher time frames than it does smaller, and that's because it takes more information to fill these charts out. In the next video, we'll take a look at trading psychology and some risk management thoughts and strategies.